So you may, like everyone else, feel negative about the economy right now. I'm here with Ann Sonders, the Chief Investment Strategist at Charles Schwab and Company, and she thinks your negativity is actually a good sign. Can you explain that, Ann?
Sure. Well, we talk a lot from a market perspective that sentiment tends to be contrarian, but it often is the case with the economy too. And the relationship between the two is that for the most part, when investors, when consumers are feeling particularly negative, it's probably because of what's already happened in the economy. The market, of course, is going to forecast what the economy is going to do, and often at some of the most pessimistic periods for the economy, more often than not, you're closer to the bottom. And I think what's happening right now is because of the pain of what we all went through in the last couple of years, the severity of the recession, I think the expectations bar for the economy is now set really, really low. When a bar gets set very low, the ability for the results to actually exceed that bar become easier, and I think that's the environment we're in now.
And you look at this historically. Can you kind of put it in perspective? Say, going back 50 years, how often do people feel this bad?
You know what, if you look at the cycle in the economy and you look at things like consumer confidence, it is rare that we see the kind of contraction in all of those things as we did during the worst phase of the economic downturn. So late 2008, early 2009, we saw pressure on many sentiment indicators that was unlike anything we've seen, say, for maybe the Great Depression. But what's more interesting maybe is that 2+ years into the recovery, albeit with a pretty tough environment, say in August and September, with the debt ceiling debate and the downgrade and concerns about a double dip in the economy, we saw another compression in those sentiment indicators that took sentiment back down close to as negative as it was back in March of 2009. And that is not normally the case. That's a very unique occurrence.
So in addition to the good news that people feel bad, you actually also see some economic indicators that are making you feel a little better. Can you give us some of those?
And I think it's not just, at any given point, if you're an optimist, you could probably find a number or two that supports your case, but it's becoming much more broad-based. So we've seen it recently on the manufacturing side of the economy, on the services side of the economy. We're seeing it in consumer spending. We're seeing it even in housing. We're seeing it in autos. Manufacturing, growth in manufacturing employment was the highest last year as it's been in 14 years. So you are seeing broad-based improvement, the decline in initial unemployment claims, the much better jobs report that we got for the last month, which had job gains across the board, not just in one particular area. Not to suggest any kind of boom, but the spread of indicators that are showing growth have started to widen.
So if in fact it does come to pass that the economy does start to pick up, does the stock market follow?
Look, I think the stock market leads. In fact, I think some of the strength we have seen in the latter part of 2011 and into the beginning of this year is reflecting the likelihood that the path for the economy, at least in the first couple of quarters, is better than the consensus. So I would actually watch the stock market as an indication of what the economy is going to do, not the opposite.
Great. Thanks very much for your insights.
Thanks.
And thank you for watching.